Okay, ladies and gentlemen, today we have a very special guest. We have Tom Asad, the founder and managing director of SMSF Partners. Tom is a local in our neighbourhood here in North Sydney. And Tom and I have been chatting in the recent years about creating more awareness to people's superannuation. We feel that there's a lot of lazy money in super, is what I like to call it. People who have more than they probably think to play with, especially if you combine it with your partner or you can combine it with a sibling. And you could do a lot with it. You can buy property, you could trade shares yourself, buy ETFs. I'm not the biggest fan of some of the industry super funds out there. I feel like they've got a lot of hidden fees that people aren't really across. So Tom, excited to have you on board and talk about these things.
Well, first of all, thank you so much for having me. It's a pleasure. It's always good to catch up with other businesses in North Sydney. So
yeah,
always
great.
a good thing.
So let's talk about, let's just start from the start for the average listener that's dialed in that doesn't actually even know what a SMSF is. What's the difference between an SMSF and a superannuation fund? What are the steps involved from going from one to the other?
Okay, so simply self-managed super funds, they've been around for quite a while. They're getting more and more popular, just as more and more people are starting to look for different opportunities to control their own super. So it's really just simply you taking control of your super balances and investing in things that you are more comfortable in investing with. So we are finding younger and younger people are starting to get a balance. Like they're starting to accumulate quite a big balance, and they're starting to get into these self-managed super funds at a younger age, which is always a good thing to see.
And what is the balance you reckon that you need to have to start considering this? Right, that's the $1 million question we get asked all the time.
We get that question all the time as well. So it's really got to do, like, so if you look at ASIC and what they say, it's really about, they always look at cost and return on investment. We always, when we're looking at them, we're always looking at it going, well, are you capable of running a self-managed super fund? Do you have an investment strategy in mind? So a lot of people are, getting into the property investing. They own existing properties outside of super, so they're kind of well informed with making decisions in that regard. So they are, the balances are getting lower and lower, but usually around the 200,000 seems to be the go.
Well, 200 seems like the amount to go purchase a property, right? But
Yep.
I feel, and that's also, I think, the key to highlight there, that could be $100,000 each between partners or siblings, like I mentioned, because you can amalgamate your supers.
You can have up to 6 members now.
Yeah, there you go, right?
So
So you could have 6 siblings. But you don't have to be family. You can do it with a friend. You can do it with anyone, right? I feel that 200 is the magic number, or maybe even now banks will take up to 100, 150 as little as for a deposit toward a purchase, because now it's becoming easier and easier to borrow in your super, which is contradictory to some previous behaviours. But you can go up to 90% now in your super on a purchase. But going back a step, I think stage 2 is this conversation where you're talking about purchasing a property in your super. I feel that, with as little as $50,000 in your super, you should consider reviewing your investment strategy, right? So the shares you're invested in, I feel like modern day consumers or investors are getting more acute with investment strategies. You've got people trading crypto at the age of 19 sometimes. So, when you said that comment before about cost, there is a cost associated with setting up the SMSF, and the regulation is focused on the cost of doing so, and if it's in the consumer's best interest. What is that cost?
So back in the day, and going back 10 years, 5 to 10 years, we'll call it, some of the costs you would see, with financial planners, accountants to set it all up, it was getting up to about $10,000. So having balances greater than, $500,000, that's where the break-even point was. These days, there's a lot, even with ourselves, with SMSF partners, we've been able to scale back a lot of these costs on the setup. So therefore, if your all-in inclusive cost is $2,500, then your balance required to, to really, when you're looking at the cost versus advantages, you can really look down and go, okay, well, 2,500 is not 10,000. I'm still left with a very good balance to be able to do, execute my investment strategy, and therefore more and more people are getting into it in that sense. So the cost barrier, I think, is obsolete to a sense, just because it is something more popular. Accounting softwares are getting better and cheaper. The establishment deeds are getting cheaper. So the cost has come down quite a bit over time.
I also think if you're in your 30s or 40s or even in your 20s, if you've got some money in super, reviewing the actual investments they're in is so crucial, because some of these retail funds, or the industry super funds, I should say, that people have their money invested in, they have an investment strategy for the broader market, which isn't suitable for someone maybe in their 30s, let's say, who might have a bit more of an appetite for risk. For example, gearing. There's personally, I put my super fund into a couple geared ETFs, some across the ASX, some across the Dow Jones and S&P, and typically I'd say 90% of superannuation sort of funds wouldn't have any form of gearing in there, right?
Yeah, correct. So most of the big funds, there's billions and billions of dollars funneling through into their bank accounts on a quarterly basis, and you'll just see them investing in, your ASX 200 stocks, overseas stocks like the S&P 500, Nasdaq, things like that. But they also, will acquire property, but they're buying whole buildings. There's big funds. They invest in the UK, in the US, in Canada. So it's really, like you said, like someone who's a bit younger, has a bit more life to them, we'll call it. Definitely want to be geared a little bit more. And ETFs, funnily enough, that's been one of the bigger investments that we've seen. More and more clients are getting, to understand how ETFs work, understand that some of them are leverage or geared, and the returns on those over a longer period of time. So like you said, like it's not someone who's 55 looking to retire in 10, it's a 30-year-old that's looking to retire in 45 years.
Exactly. And so, the risk with gearing, obviously having some debt or leverage in your investment strategy, just means you need to be able to ride through tough times like now, where the share market's going through a bit of a correction. But being, young, you've got that time up your sleeve.
Well, that's it. Time.
It's a great time right now to readjust your superannuation, in my opinion. If you can enter in at these suppressed prices, it's not so suppressed anymore, but still some opportunities out there. It's a great time to recalibrate your investment strategy. Going back to also, let's just keep on this when to set up an SMSF type topic and when to probably identify yourself as being probably at the right time. I think the thing that you should really highlight here, is that, let's say you only have 50,000. I say only 50,000, still a lot of money to play with, but let's say you have $50,000 in your super. If you're at a position, there's a lot of self-employed practitioners out there who I've noticed they haven't been contributing to their super, because being self-employed, you don't need to unless you're paying yourself a salary. Sometimes they get to a point where they've had a conversation with their accountant and had a realization that, hang on, I should be now making, at least 20 grand a year contributions to my super, but they might only have $50,000 in their super at that point in time. That would be a person who's probably relevant for this conversation, because whilst they only have 50,000, clearly over the next 5 years, it's going to accelerate in balance a lot more aggressively, given the future contributions, right?
So that's definitely something I know a lot of accountants talk about, especially this time of year. We're in May right now, coming up to end of financial year. We're talking about tax planning, minimizing, your taxes on your personal side. So topping up contributions, making sure you're hitting those caps is always important. Like you said as well, like a lot of small business owners or medium-sized business owners, they tend to forego contributing into super just because of cash flow, or maybe not so much cash flow, but that they would rather invest their money elsewhere.
So let's elaborate on that. Sorry,
but I got a client. Like I actually had this conversation yesterday, and he's early 30s. He runs his own business, very successful business, and he hasn't been contributing any super. his whole life. So he's 32, 33, no contributions whatsoever. And the simple question was like, well, why aren't we contributing? And his simple answer was like, oh, there's no point. It's just going to get eaten up in fees. But the conversation then led to, he's running a very successful business. He wants to buy a warehouse. And his next question was, can I do it through SMSF? And the answer is 100% yes, you can. There's special rules you need to follow. But then the question comes on, how do I get enough money in there to leverage to purchase this commercial property so I can lease it to my business? And that's why starting now is always better than waiting 5 years, 6 years until that investment pops up.
Yeah.
That way you have the balance, you have the funds ready to go to do something.
And especially if you start now, the investments that you make are in a low tax environment of 15%, right? So the compounding effect of investing in, some geared ETFs and whatnot will, over a long period of time, is far greater than doing it in your personal name or in some sort of investment vehicle.
Well, 15%. There's no other structure in Australia that taxes at that low rate.
Yeah.
So we're pretty lucky in that sense too.
There's a few things you touched on. I want to keep going back, but you talked about caps, getting money into super, and also buying a property for your business to occupy. 3 great things that probably cover. Let's talk about caps. People might not know what we're talking about there, but I feel, this is a thing that we do need to highlight more, that if I think the top income bracket still is 180, isn't it?
Yeah, correct.
Once you're over that threshold, you're basically paying, almost 50 cents of the dollar tax.
Yep.
And if you're well above that threshold and you're not making those contributions at the capped amount, in my opinion, or at least 10, 20 grand, I think it's just silly. I guess the best way to explain these caps, so what is it now, 25?
27 and a half.
27 and a half?
Yep.
If you do put the 27 and a half, you're basically getting, call it 13 back in tax, right?
Effectively, yeah. So it just depends. There's a sweet spot. So if you're earning anything over 250, you pretty much used up your cap, so you got to be very careful with that, because that 27 and a half includes your employer contributions.
But that's 250 if you're PAYG.
Correct.
Yeah.
But if you're self-employed, yes. So you just do the max contribution amount, 27 and a half.
So a lot of for the self-employed sort of practitioners out there, it depends how you've structured yourself, but if you're a company paying yourself distributions or dividends, then you're probably not paying yourself superannuation.
Yep.
If you're paying yourself a salary, you would be, but if the salary is not over that 180,000, then you've definitely got some room up your sleeve there for additional contributions, where, like I said, it's basically dollar for dollar. So every dollar you put in, you could think the ATO is matching you. So you may as well put it in there, and then in that environment, you're getting 15% income tax. So big believer in that. Second point, we were talking about, we had the occupying your
business
premises in your SMSF. People love doing this. Why?
This is the most common, like for small business owners, tends to be the number one investment for them. So, paying rents, they tend to, with commercial property specifically, they tend to increase with CPI or inflation. You don't, imagine moving a business. It is not easy. It is not a cheap exercise. There's a lot of downtime. Specifically going back to this example of a client, he has like a panel beating business. So going back to that, if he was to move the spray booth, all those bits and pieces, it would cost him quite a bit of money. So they kind of want that security of knowing that their business is going to be run in that space for the foreseeable future, effectively. The other side, and then so the rules allow you to invest in the commercial side, like whether if it's an office or a warehouse, and then lease it back to your business. There are some rules there, so that we have to follow. So
market rent,
that's the big one. So it's not like something where, if you had a slow month or something like that, you can be like, look, I'm not going to contribute, or I'm not going to pay the rent to the super fund, because it's mine anyway. You have to treat it at arm's length. So that's the key there, is you got to treat it at arm's length. The other side of it is actually a lot of people are interested in investing in commercial property just for the rental yield.
Yeah.
So,
Well, we had the realization years ago that the amount that you pay for some of these in office space, for example, the amount that you pay in leasing is basically the same you would pay in repayments if you borrowed almost the entire amount.
Yeah.
So it's a no-brainer, even if the asset value doesn't appreciate for years, which sometimes in strata offices that can be the case. You're going to make it in yield, right?
But you are making anywhere from like 6 to 8% rental yield.
Yeah.
And the longer you hold on to it, the higher that yield tends to grow. So,
and another great thing that I witness clients doing all the time is maybe a grey area we don't want to bring too much attention to, but if you have a business that your super fund is leasing a property to, if you want to improve the property, now technically in commercial lease agreements, any improvements, fit outs is on the tenant. And the best thing is that your business can take an expense or depreciate the cost of renovating the property, which is in your super fund, and then the super fund indirectly inherits the asset appreciation.
correct.
So your business is getting a cost, and your super fund's getting a free injection.
Definitely, we see that a lot in, like you said, with the lease agreements. Effectively, the tenant, if any improvements are made, is on the tenant to look after.
Very different to residential tenancy agreements.
This is just commercial. This is definitely not anything to do with residential. There's different rules around that, and we can touch base on that in a sec. But mainly, around the commercial side. So you can either leave the property as is, or you have to pull it apart effectively.
I remember there was a point that we were going to touch on about that in those 3 points. The second point was actually going to be getting money into your super outside these caps, right?
Yep.
So some people have this realization, like your client did, that, hey, I might buy a factory for my within my superannuation for my business, but then they've realized they've haven't been making the contributions. And there are sort of two ways of making significant lump sum contributions, right?
Correct.
I believe one is to go back and you can retrospectively make those contribution caps you haven't been making
5 years.
5 years.
So bring forward rules for 5 years.
Yeah,
that's the key.
So if it's 27,500 a year, you can go back 5 years worth and make a lump sum, which you will get a deduction off your taxable income for.
Correct. Yep. So the first thing I always say with that is talk to your tax agent, because they can look up your bring forward rules and max concessional contributions caps.
Yeah.
They can give you those figures for you, and yes, they are deductible on that side. There's also non-concessional contributions.
The second one.
So the second one as well. So there are some caps there, and it's a rolling period, but you can effectively, if you needed to have, and you had the cash, you could potentially have about 500 to 600K in super in a year if you needed to.
Is that from a combination of the two?
Combination, yeah.
Because I think the non-concessionals, is that 110 a year, was it?
Yep,
and
correct.
you can do 3 years worth at once.
Yep.
So from a combination of the two, if you had the money, you could put $500,000 in there.
Roughly, yeah. It just depends. And then it's also timing as well. So, if you're doing it right now, well, in a couple months' time, like we're in May now, in 1st of July, you can, do another concessional contribution. And so it's just really also timing when it comes to these sorts of things.
Because you could do it, make one now, and then in a
effectively,
when you tick over to the next financial year, you can then do it 3 years at that point.
No, not 3 years, but you still get to do the concessional contribution. So another 27.5.
The big difference, I think, between those two that everybody needs to get their head around is that the former, the cap one, you'll get a deduction off your taxable income.
Yep.
The non-concessional one is from tax money.
Post-tax, yep.
So there's no deduction. So you always want to try and do the caps first.
Yep.
And then you can look at the non-concessional at the point of a transaction. I know from a lending point of view, you can get approved based on that non-concessional contribution coming in. So as if you're going to make the money, you've got the money. One thing to note, though, correct me if I'm wrong. A lot of people like to borrow money against their home to make this contribution into their superannuation. Let's say you want to put this whole $400,000-$500,000 into your super to go buy a factory. You can't claim that loan for investment purposes going into your superannuation as a contribution because you don't get a yield from it, right?
Correct. Yep.
Yeah.
So you can't, like, if you're drawing down equity just to make that contribution, that equity drawdown is not a deduction on your personal side.
So would you probably advise against that?
Just depends on the situation, really. Like it goes back always to investment strategy. So depending on the client, depending on their circumstances, will depend on whether that's a strategy that works or doesn't. I have had a client in the past where he ran a mechanics business, and effectively the property came up for sale, and he needed to move quickly, and he didn't have enough super in there, and he needed to inject some funds in, and he did do that. He went down that road, but his investment strategy was to effectively secure this property for his business, So it just, every situation is different, and that's where having a chat to us or your accountant, kind of goes a long way to helping you make that decision.
So let's now talk 10, 20 years down the track. You've digested these points with your accountant. You've made the contributions into your super one way or another. You've bought a property. What are the benefits long term? So once you hit retirement, then what?
So retirement, you got all the, going back to it, it's like you still got the benefits of owning a property. So you're still collecting rental income. You still got the growth on these properties, whether it's commercial or residential.
At 15% as well.
Lower tax rate, which is always good. And there's still the same deductions effectively to be claiming. So you can still claim all your council rates, your water rates, any repairs and maintenance, all the interest that you're paying to the banks, and depreciation depending on the property, of course. But then, once you hit to, once the account converts from accumulation to pension, that's where it gets really good. So, your tax rate effectively goes to zero. There's no capital gains tax on the property if you decide to sell it. It really gives a lot of options to you when it comes to retirement. And that's something, that's
So
really
let's highlight that because I think we need to give more attention to those wins. So if you're in your 40s, right, and retirement's, a bit over 20 years away, and you go buy $1 million property, right, and we assume that the property market doubles every 7 years, that $1 million property would probably be worth around $8 million by the time you retire. So once you're in your retirement stage and you've got this $8 million asset, if you decide to sell it, it's entirely capital gains tax free, no tax at all on that capital gain. Or if you decide to keep it as a investment property and just collect the rental yield or rental income, the income is entirely tax-free. And if we assume an $8 million property is renting at 5% yield, that's $400,000 a year tax-free. So it's a fantastic opportunity to create wealth in your retirement and plan for a comfortable retirement, which I just don't feel people are across. All right, so another good strategy that I've seen is family members, not necessarily, husband and wife, but also children sort of combining together with their parents to almost create like a family unit in their superannuation. I think I've even seen grandparents sometimes do it, and it's a great way of the family sort of working together purely for investment purposes. So I think, wealthy families like to do this because they want to incentivize the kids not to go buy, luxury homes or cars or anything like that. They want to make sure that the next generation is thinking about wealth creation for their kids. And so by putting the money into a superannuation and getting everybody to work together, they can't touch it, they can't spend it. It is purely on investing. What's your thoughts on that?
Well, we're seeing this more and more often. So, usually you want to, when you set up a fund, usually husband and wife tend to be the first initial members.
Yeah.
We're starting to see they're 19, 20, 21-year-old kids joining, and what that's creating. And going back, we did mention you can have up to 6 members in a fund. So, they did increase that. It was capped at 4. Now it's up to 6. So bigger families can be a part of this. But what you're realizing is a lot of mums and dads are bringing their kids in to get involved with self-managed super funds, effectively just so that it's building that family wealth under a great tax structure.
Yeah,
but also at the same time, when we're picking up a lot of the younger generation are either very eager to invest but don't have any funds personally to invest, or the complete opposite. They have no interest in investing whatsoever, whether it's property, ETFs, crypto, anything like that. So the family or the mum and dad tend to want to push the kids to help with the investment strategy, come up with a strategy, to diversify their funds and things like that. So we have seen that more and more in the last couple of years, where some of the older generation are pushing their kids into the self-managed super fund just so that they can kind of get involved with with investing.
It's also good because the kids obviously on their own can't really do much with their superannuation balances.
Correct.
Amalgamating that family balance can lead to much greater opportunities.
Well, more money, bigger investments, better returns. Just especially if you're going down the leveraging road. I think having a balance of $500,000 versus $1 million, you're going to get different opportunities really to invest in multiple things or just bigger things in general.
The other thing I really want to touch on, just to, I guess, wrap this up, the difference between, let's say you've got $200,000 in your superannuation, and it's sitting, it's between you and your partner, $100,000 each, sitting in 2 industry super funds, where you're aiming for, what's a good year? 10%? You're aiming for 5 to 10%. I think on average it's probably around 7% performance, right?
Yep.
So you're hoping for your $200,000 to appreciate, call it 7% a year. That's $14,000 a year. If you had that $200,000 invested in a property and they bought a $1 million property, which you can now because you can borrow up to 90%, like I mentioned, let's say historically in Sydney in particular, you should be aiming for at least 5% annually in growth. Obviously, if that property is growing by 5% on $1 million, that's $50,000 a year compared to $14,000 a year on the retail or the industry super fund. So, I think people need to realize that when you compare the share market to property, the big difference is in the two, especially in your superannuation, is the leverage. You'll never really gear your share portfolio up to 80 or 90%, and I don't think it's even really possible.
I don't even know any lenders that do that. Any top tier lenders.
The gearing I was referring to in these ETFs and funds are more around that 50% mark, and even 50% is considered quite aggressive.
But that's them doing it internally.
And they're doing it internally, yeah.
So it's not you borrowing money from the bank to invest in.
It's a geared fund, so it's not on your balance sheet as a liability, which is good. But the gearing that you do on property at 80%, 90%, you will never do that on your share portfolio, and you're effectively getting capital growth on the bank's money. Yes, you're paying a decent interest rate for it. So SMSF loans are a higher rate than normal sort of investment loans or owner-occupied loans, purely because they're non-recourse.
Yep. Recourse.
They're at arm's length from you. But even at that higher rate, you should, the rent should be covering your interest costs. If there's a small deficit, your contributions should be covering that difference. So even if it's breaking even, the capital growth comparison in that situation, $200,000 earning 7% would be $14,000 a year, or $1 million property with that $200,000 deposit, 5% is $50,000 a year. There's $36,000 a year difference in those two investment strategies. So, in my opinion, I think buying a property in your superannuation is a no-brainer, but you need to take the right steps to get there. A lot of people think that it's not ascertainable, but that's not true, because if you're doing these little things like making those annual contributions, especially if you're a self-employed practitioner, I think that something that we could change differently in our sort of tax system. I think it's an issue that self-employed practitioners have that discretion to put money in their super. Because what I witness is people in their sort of 20s, 30s, and 40s, they really try and retain all the net cash they possibly can for, paying off a home or growing the business and whatnot, and they're not forced to make those contributions when they probably could have made those contributions, because if you think 10, 20 grand a year is actually only 5 to 10 grand a year net cost after tax if you're in that top bracket. So that's, I think, something that people need to be mindful of. If you've got that, call it $5,000-$10,000 spare change a year, it should be going into your superannuation. That's for sure.
Well, minimising taxes, growing super balance, there's a whole heap of different positives there for you.
And there's an issue there, I think, across the country that a lot of Australians don't have enough in their superannuation. If you have $1 million in your super, you'll be hoping to get $50,000 a year income off it in retirement. But a lot of people don't even have $1 million in their super, and $50,000 a year is hard to live off.
It's not much if you think about it, like $50,000 a year, and you also want to leave. I don't know. If I would want to leave something for my kids,
exactly.
So like if something was to happen to you, I'd want to leave them something, and I would also, once you've retired, that's when you want to enjoy life. You want to travel more, you want to buy the nice car that you should have bought in your 20s, but you're now buying now. So you definitely, I think, need, more than the $50,000. But going back to the 200K balance and the mum and dad, and they're thinking about it, I find a lot of people are actually not across their super. They don't look at their super, but like they get the statement in September, they look at it and they go, "Oh, my closing balance is this," and then they just put it aside. And I feel like once people actually start looking into it and they start thinking about it, and this is where we've had a lot of inquiries about SMSF setups in the last 6 to 12 months. And it's really just because, they've received their statements, and the people that are actually going through their statements to see what kind of return am I getting, what kind of fees I'm getting charged. That's the big one. What kind of insurance fees I'm paying. Is it a good policy? Is it not? Talking to insurance guys. And then they're going, well, I can replicate this, or I can do a better job.
The fees is a big one.
Yeah, because it's not on the front page.
No one actually realizes what fees are being charged. I was guilty of that myself. Yeah. How some of these industry super funds and whatnot operate as a unit price, like a share price of the fund that you're in, and they take the fees out of the unit price. The price just gets adjusted annually or quarterly. Based on the fees that they're charging. There's also performance fees in some of these things where if they do have a great year, we get extra because we've done a good job. Anything above sometimes 10-15% growth, they take a higher clip on.
The easiest way to do it is actually go, it's about a 15-page document. You should go through every single page because I think it's closer to the end.
Yeah.
They'll tell you what they charge you in direct fees and indirect fees.
Yeah.
And that's where, I think it makes a big difference. Like when you start seeing all these things, you'll start realizing okay, well, I'm getting charged this much. To do the tax return and audit for an SMSF, they're fixed fees. They don't fluctuate as the performance,
Exactly.
If you had a great year or your fund doubled, we're not charging you any more for that because you're worth more, so we're going to charge more. It's a flat fee service, so that's where you can save money with SMSF. But also at the same time, actually look at your contributions, how the fund performed, and then your closing balance. And I think that's the other side of it. Is a lot of people don't pick up that most of the gains sometimes can be contributions.
And that's why also, even if you're not at that scale yet to go consider buying a property in your super, if you just change your investment strategy and go out of these sort of industry super funds and look at buying direct shares yourself. Like you can't go wrong with buying
Yep.
our top ASX 200 companies and diversifying yourself, or even some of these ETFs. Whilst they're still funds, the fees, correct me if I'm wrong, are a lot lower.
Very minimal.
Yeah.
I think like Vanguard came out, they had. I think I was actually reading about it. They all most of them dropped their fees this year because they're getting more and more popular. And it's something that you don't have to stress about on a daily basis. Is BHP doing the right thing, the wrong thing? Are they going to get their iron? Are they going to hit guidance or they're not? Those funds can look after that side of it
Spot
for
on.
you with the lower fees for it.
I think that's a really good, valid point to probably wrap up on. You got to identify yourself as an investor.
Yeah.
And are you the person who's going to go through your 15-page superannuation sort of annual report? Are you the person who's going to read the quarterly reports from the shares that you've purchased on the ASX? If you're not, pay a fund manager to do so. Just make sure you've picked the right fund manager.
But and that's going back to if you are an investor and you have an investment strategy, let's say for instance, and we'll go back to the property side of things because that seems to be a fan favorite. If you have an investment strategy, you've done it before, you know how it works. Taking those next steps and finding out, okay, well, this is how much super I have, this is how much super my partner has, this is how much contributions we have. It's not hard to get a quick borrowing capacity done. Then going back with that and going, okay, well, does that fit my investment strategy? Does that fit my investment goals of what I can achieve? And if it ticks all the boxes, it's not hard to then start progressing through that. And that's what I tell a lot of people, like especially there's a lot of people in the early 30s now, and they want to invest in things that they're comfortable with.
That's just on that point on the borrowing capacity. It has gotten easier to get a loan approved in your super in the sense that it used to be always on historical contributions. They want to see how much you've been putting in your super in the past. However, now lenders will take a letter from your accountant based on your willingness to make future contributions, which is fantastic. Quite unique, really, but that makes a big difference, we find, in getting the borrowing capacity to the level that the consumer wants in their super.
And then also there's more products out there. I remember 5-10 years ago, it was quite an ordeal trying to set up, get the Bear Trust set up, get everything choreographed to settle on property. It was a little bit more difficult. These days, it's so streamlined. It's probably faster than I don't know. You would know this.
Yeah, no, it's definitely fast with the specialist lenders in that field. And I think one thing also to highlight on that point, we touched on this the other day, is the SMSF lenders that were the most used lenders 5-10 years ago are now out of the SMSF space. And if you're one of those people that did buy a property in their SMSF sort of 5-10 years ago, we urgently encourage you to review your SMSF statements, your loan statements, because most likely that bank has jacked up your interest rate to 9-10% because they are trying to actually clear out their SMSF portfolio and they don't want you to be there. They want you to refinance.
Well, yeah, that's something we always look at, especially with tax time. So when we're processing the returns and stuff like that, that's one key thing that I feel it's easy money save. Like it's an easy strategy to save money and it is easy to refinance. There is a big misconception that you can't refinance in SMSF. And, we've seen some, I won't mention which banks they are, but we have seen some banks up at 10%. And these are 5+ year loans.
Yeah.
LVR has come down. And sometimes you just sit there and, we have to urge the client and give them that gentle push. Like, hey, the market is currently, lending out money at this rate, you're paying this. There is a 3-4% difference. You should definitely go and look into refinancing.
But some of these banks that are now out of the SMS space, they won't even budge on rate.
No, they won't. I've seen that, because we get called a lot of times and, shall I give my bank a call and try to, and the answer is always like, look, I have had previous clients go through this. Just talk to a broker, talk to Shaw. look into your refinancing options.
Well, that's a perfect probably segue to a conclusion of today's podcast. Tom, thank you so much for coming in. Guys, if you want to hear anything more about SMSF lending, if you want to speak to one of our brokers, give us a call or hop on our website, shorefinancial.com.au. Tom, thank you so much.
Thank you for having me.
We'll be directing any SMSF inquiry your way.
Thank you so much, mate. And thank you so much to Shore for having me tonight.
Thanks, guys.